Thanks a lot, Suvajit, for joining us. So basically, this session is about the importance of bonds in anyone's investment portfolio, right? I think we all know about equities, we all know about mutual funds. I think a lot of us also invest in debt mutual funds, right? But this session we wanted to at least talk more about bonds, right? Actually, before we start, a little bit of introduction. So, Vijit, I think if you could just sort of introduce yourself so that it would be
Yeah.
great for the benefit of the audience.
Thanks, Mitra, and thanks, Dilip, for inviting me for this show. Hi, folks. My name is Shubhajit Ray. I work for IFL Securities. I head the entire portfolios for product, for distribution, and work as a principal officer for IFL Securities. And IFL Securities, while we talk about, it's more that we talk about how to manage your wealth, preserve your wealth, increase, and risk mitigations. So I believe today, Bond Pe Charcha, when the request came to me looking at the current market scenario, I believe that's extremely apt subject to discuss and for the investors to invest with. I believe this is one of the best scenario that we can discuss. So I believe, yes, thank you so much, Dilip, for inviting me for this show.
Hey, thanks. So I think for the benefit of the audience, I am Dilip. I work with Paytm Money. I look after the bonds product here. In my earlier avatar, I used to be a fund manager in Edelweiss Mutual Fund. I was also the CIO of Edelweiss General Insurance Company. So I come from an investments background. So anyway, let's get straight to the topic. So guys, maybe Jani, you can help us on this, but maybe we'll do a bunch of I'll ask the questions to Suvajit, and maybe once we are done, we can open up the thing for the audience. That works, right?
Yeah.
Yeah, cool. Okay, cool. So let's start off. So I think so basically I think that the first question which everyone would ask is basically what are bonds, right? What is this thing called bond? I've heard of James Bond, but what is this thing called bond?
Before that, I just want to set a perspective for all of us. Like, say, in last 5 to 6 trading days, that while we have seen that Nifty got corrected by 1.77% and also Sensex by 1.6 plus percentage. Bond, I believe, is one of the most secured and debt securities, and it's pretty much, it's like IOU. It's like the borrower issue the bonds to raise the money to the investors who is willing to lend the money for a certain amount of time. Now, for a companies to issue a bonds, it is very, very easier aspect because dilution of the equity in terms of that raising money from the market through bonds is a extremely easier way to do that. So if I in a very nutshell and is not in a proper nomenclature, if I wanted to say what is bond, then a person when a lending a company or government, anybody wants to raise our money through this, it could be government, municipality, corporation, corporate. They raise the money from the investor into the market. In returns, they promise to pay a certain percentage of rate of interest, which is being known as a coupon, with a specific time period, which is specified at the time of issuance of the particular instrument, debt instrument, which is the tenure. And at the end of the tenure, the bond, specifically this asset class, gets matured and you get the face value. The coupon, which is a rate of interest, which you can get it either half yearly, in some cases of NCD, you can get it monthly, annually also, and at the ends of the maturity, you get your face value. That means, say for an example, the issuance of a bond is of 1,000 rupees, of a lakh rupee, or a 10 lakh rupee, you get your face value back from the lender. Now, what I believe that in other way, the bonds, NCD, debentures, there are various synonymous subject which is there in the market for issuance. If I really talk about as a genre or the class as a debt instrument for fixed income asset class, then bonds is one of the very, very safe instrument to, to invest with, where you can predict the cash flow for next 5 years, 10 years, for the tenure of the particular instrument. So that's in my sense is a true definition of a bond is.
Good, thanks. So actually, one interesting thing which I think a lot of us don't notice, but I'm sure a lot of people here without sort of knowing it might have also issued bonds, right? So let me just sort of explain what I'm talking about, right? Now, a lot of you might have taken a home loan while you are buying your property, right? Or you might have taken an education loan, right? In essence, what you have done is raised a bond, right? You as an individual have issued a bond, right? Now let's take that example, right? So let's say when you have taken a home loan, right? What do you agree with the bank, right? What you agree with the bank is that, hey, I am buying this property, and against this property, I have certain money which I can put myself. Can you please help me fund the gap, right? So basically, you are borrowing money from the bank, right? And when you borrow money, you agree to certain terms and conditions, right? You say that, hey, the tenure of the loan, right? Ki, I'm going to pay back the interest and principal over a period of, let's say, 10 years or 15 years or 20 years or whatever the time period might be. So that is the maturity of the bond, right? You also agree to a rate of interest, right? And you say that, okay, I will pay this rate of interest either in the form of, let's say, EMI, which is monthly, or depending on the nature of your contract with the bank, you could also sort of come up with some different structures, right? In a sense, what you're saying is you're paying the bank on a monthly basis the coupon, right? In the case of property loan, it's slightly different in the sense that along with your coupon payments, the interest, you're also paying back a little bit of the principal. But conceptually, just like a company raises a bond, you have also issued a bond, right? Where the maturity period is the time period of your loan, and the interest that you pay is the coupon, right? And obviously, at the end of the period, that you know that you have to pay back the whole amount, right? Now in the case of a property loan, the property is the collateral against which the bank has given you the loan. So in that sense, it's a secured bond, right? So yeah, I thought this was a good way to sort of explain bonds to a layman, to say that bonds is not something which only institutions deal with. It's something that you as an individual also have must have probably raised a bond, right? So good. So with it, let's go on to the next sort of thing. Like I think now we sort of broadly understand bonds as bonds are basically instruments which pay you fixed sort of returns at periodic intervals,
Right.
and they have something known as a maturity, at the end of which you get back the original amount that you have invested in. Right?
Right.
Now, why should an investor consider bonds as safer than, let's say, an equity investment or a mutual fund investment?
Yes, because what I believe that equity investment should be a part of your asset allocation. But if I really talk about bonds to invest with, that you need to understand that's a fixed cash flow, a fixed amount of return. Now, looking at the current scenario, if I really wanted to fix my cash flow and my coupon earning for next over say 8 years, 10 years, then bond is one of the best instrument to deal with. And if I talk about that, why people should considerably looking at bond as a safe investment, because it's very, very safer instrument. It does not relate with a market sentiment of say equity market is going up, whether my asset is appreciating, equity market is going down, so my net asset value is going down. In case of the mutual fund or the direct equity, it is a fixed. So it has to be have a very, very balance between the risk and returns varies between a type of investment and the entities of the issued by state economics of the cycle of the securities of the market. Now, bonds typically represent the debt. Investing into the debt, it's always relatively safer, and that's because of the debt holders always have the priority over the shareholder. Now, for an instances, if any company who is issuing bonds and it goes bankrupt, say over next 2 years, 3 years, in that kind of a scenario, it is always mentioned that in case of the debt holders or the creditors are ahead of the shareholders in the line to be paid on. So, in terms of getting your money back, in terms of any exigencies, also in that kind of a scenario, bond is extremely a stable instrument to invest with. Now, it has no relevance. Say, for an example, any bonds which has been issued, whether it is a government or a private corporate body issued now, and gives you a commitment for next 6 years or 5 years, a coupon of say 8%. Then for next 8 years or 7 years of this particular tenure, you're going to get the same 8% coupon. And at the end of this, you can get the entire maturity proceeding. So what happens during this 8 years, whether it is a monthly, whether bi-monthly or annually, you start getting the fixed corpus. So there you can plan your cash flow predetermined. You can plan your expenses also, and you can get to know that whatever may be the market rate of interest, which is whether the repo rate, there is a correction, there is an increment, there is a decrement also for next 5 years. I am protected of my interest of say investing 10 lakh rupee into that 8.9%, and for rest next 8 years, I'm going to get that fixed maturity benefit. So that way, I believe it's one of the best instrument to invest with, because uh, every bonds with comes with a fixed maturity, with a fixed coupon rate, uh, and it is pretty much volatile, less volatile in compared to the equity, because unless it is being traded, because there are a lot of bonds which are the zero coupon bonds when it gets traded. So that's a different perspective which comes in. But if I talk about the normal bonds, it is a way easier way of investing, and a best way of asset allocation and hedge your entire portfolio.
Okay, cool, cool. Okay, so let's say that now even in bond, you know that there are a wide variety of bonds. Like if you have multiple equity instruments, there are a wide variety of bonds as well. What are the different sort of types of bonds, and secondly, what are the factors that I should sort of keep in mind while investing in a bond? Right, when I evaluate the rate, there's let's say there's a company A which has issued a bond. How should I evaluate whether it is good for me?
Okay, so first I will answer the second question, that how do I identify, because for any investor and a prudent investor should have a prudent understanding about the particular issue or the instrument, because most of the times it happens that either it's a bandwagon effect where I just got to know that some bond issuance or the NCD is going on, and I have just invested my 10,000 rupees or 50,000 rupees. A person should know what is the risk of that particular bond, what is a rating of that. So every bonds comes with a rating, which is a double A, triple A minus, which is rated by either ICRA, CRISIL, CARE. There are new agencies which are also being introduced now, like India Rating. So you should be knowing that a triple A rated is a one of the best and most secured rating for that particular instrument in compared to A. Second is that now, if I really talk about the type of a bond, there are various types of a bonds. Again, I'm trying to say bonds or the debt, the fixed asset plus. If I talk about, there are various names. Now, if I talk about, there would be bonds like say fixed rate bond. There are floating rate bonds. There are inflation linked bond. There are zero coupon bonds. There are FRBs. So there are many types of bonds. There are NCDs which are also there is actually a genre of bonds. There are perpetual bonds which are which you can buy. There are 81 bond, 82 bonds that you can also buy, which are primarily linked to your bank while they raise the capital. There are government secured bond. There are state government secured bond, which are pretty much a sovereign securities of the bonds which are being given. There are tax saving bonds which are also available into the market. So foreign investors, I need to always suggest that you should understand that what is your mission of the investment. Now, you wanted to protect and you wanted to get a regular cash flow for over next 8 years, bi-monthly or monthly or annual, then a proper, you should study a double A or triple A rated bond. You should also see the information memorandum of that particular company to understand that whether the company in the past, which are the bonds that they have issued, what is the payback cycle of them, whether they have a proper escrow account system or not. So in this, you can actually understand that whether I'm investing into a right asset class or right instrument, because in now the bond has become over the last 3 years has become a very 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 vast subject. You will find that there are a sub date, there are subordinate date which is listed, which are unlisted. So there are various subjects into it. I'm not going deeper into those asset classes also. But for a normal retail investor, you should also know that what is your rating of this bond, whether you want it is for the capital preservation, when you want it to for the income generation, for you wanted to do it for the capital appreciation. These are the broad things you should keep in your mind while you're investing into the bond.
Okay. Okay. Cool. So was it actually a couple of years back we had this instance of DHFL, which sort of defaulted on its bond, right? So could you sort of help us explain exactly as to what exactly happened? What happened to, let's say, an investor who was holding the bonds of DHFL, and sort of how do we make sure as investors we stay safe from such instances?
So there are many instances in past which has happened. DHFL is one, Shreya is one, Reliance Capital is one. We have seen where people have invested. So exactly that's what I'm trying to meaning a point here. Like very recently, there was, I don't wish to take the name of a company where they have raised close to 700 crores from the market, where the rating was by India credit rating A minus. So I was surprised that in a 1 day or 2 days, the entire issue got subscribed. Where as a one of the largest wealth management issuer, we have not suggested to the customer. Reason being because as the time of investment, you need to look at that which are those instruments that they have issued it earlier. One, what is the repayment structure? Whether they have repaid it into the market. Secondly, you can also normally can get to see whether the bonds is being trading at a discounted price into the market. You can get to understand that if the bonds are trading at a discounted price, that means there is something wrong. That means there is no taker. There is no premiumness of that particular bonds. Secondly, if any company when they go for a bankrupt, as I mentioned, it's called IOU. That means I have borrowed that money. That means DHFL, I have borrowed the money from the retail customers. So in case of any transfer of asset which happens like DHFL, Piramal Enterprise and the Piramal Housing Finance, they have bought the entire asset class of the bonds of the DHFL. In that kind of a cases, the implication goes to Piramal to pay back all the capital which has been invested by the investors with them. Now there are various dispute which comes in between one. That at the time of if that goes for a NCLT and the NCLT they gives an order on the sale of the instrument, before you pay to the shareholder, you have to first pay to your bondholder. So, in terms of your investment, that is, you are invested, say, 10 lakh rupee, 5 lakh rupee, that investment is secured pretty much. Even we have seen that in case of a bank where a perpetual bond, there was a problem and the recapitalization happened for the Yes Bank by the SBI and other, where the investor's money is pretty much protected. In that kind of a scenario, what we have observed in the history that some point in time there has been a loss of interest which need to be foregone, which has happened also in the past. But yes, my suggestion would be whenever you invest into the bond, you should check the credibility of that particular company, that whether they have issued a bond for last 5 years, whether they have paid the bond, the entire face value back to the customers, whether they have on time paid that amount to the customers, and all those stuff. But in terms of protection of the principal, that is pretty much there. NCLT, when that goes to an NCLT, there were a lot of PILs got filed for the DHFL. The investors have got back their invested amount, not the coupon which was assured on that point in time. Yeah.
Okay, okay, okay. Actually, Sojit, could you also sort of, at least from a retail investor's perspective, I know that from an institutional investor's perspective, there are a lot more varieties of bonds, but from a retail investor's perspective, what are the sort of broad categories of bonds that they should look at? And let's say if someone is new to this space, what should they start off with?
So, my sense that a retail investor, like say for an example, a person wants to invest 10,000, 50,000, they should look at the investment of NCDs, which is a pretty much easier. Second is like say for an example, just a couple of days back, the sovereign gold bond, which got closed. So these are the bonds which are extremely good. Like say if I talk about sovereign gold bond, which is an SGB, where there is a sovereign guarantee which has been given, you get 2.5% annually for that particular. You get an appreciation of the gold for over 8 years. After 6 years, your option of the exit gets open. So sixth, seventh, and eighth. Eighth is a maturity. Sixth, seventh, and eighth, you can just exit from the instrument. So, to begin with, for the retail investor, like say Muthoot Finance, there is a one bond which was just closed down on 19th of December. Like Indiabulls Housing Finance, there are two more bonds which are coming. Like National Highway, anybody can actually, without looking at that, NHI is one instrument that they could have actually invested. Surprisingly, you know that in one day the entire issue got oversubscribed. So, like say Muthoot Finance, they have raised the capital almost thrice in this particular year. Indiabulls almost thrice they have invested. Uh, so, like Edelweiss Broking Limited, Edelweiss, there are many investment which is there. Navi FinServes, which is doing extremely well. So, if I talk about the rating, like they are always double A rated. Like say Muthoot Finance is a double A plus, stable rated by ICRA. So, to begin with, for the retail investors, I should first say that you start investing and don't miss out the opportunity of the SGB, which we call the sovereign gold bond. Then anything like tax-free bonds, that is not, there is no primary issuance of that, but if you can buy it from the secondary of the market, which you can invest. Otherwise, NCDs are the very, very good tool to invest with now. And this time, what I believe for the next 18 months to 22 months is a time where you will really see that there are a good amount of an horizon of investing into the bond, because looking at the repo FedEx rates going up, where the inflation will be coming into the control, this would be the best instrument to deal with and protect and hedge your the entire portfolios.
Okay, okay, okay. Actually, Sojit, uh, you said that primary market, secondary market. Would you sort of explain that a little bit more?
So primary market, what happens that, say for an example, like say Muthoot Finance bond, which got closed on 19th of December. Now the allotment will going to happen in next 7 days. Now once that happens, there are options that a retail investor can sell that particular, because each one of the bonds which has an ISIN number, and they are listed into exchanges, NSE and BSE, and those bonds are also tradable into the market. I'm not talking about the liquidity, because liquidity sometimes become a challenge, because liquidity means buyer and number of buyers and number of sellers. You will not find that there are too many number of sellers which are there, or too many number of buyers which are there. But if you are a retail investor, like 10,000 rupees, 50,000 rupees, or a lakh rupee, you will find that amount of a volume is trading at every time. So as an investor at the time of during the issue time, which is say for Muthoot Finance, I am just taking an example. 28th of November, the issue got opened, and 19th of December when issue got closed. Now, in this kind of a scenario, you can subscribe for that particular NCD, and NCD got allotted, will be allotted at the time of allotment. The minimum face value was 10,000 bucks. Now, the after the allotment of that particular instrument, that started get listed into the exchanges, which is NSE and BSE, and after the listing you can buy or sell that bond from the secondary market. That means from the normal equity market, jahan se, like say I'm just buy my normal equities from that market. Also I can also buy IFL Finance bond, I can buy Muthoot Finance, I can buy India Bulls Housing Finance. So that is called the secondary market. So during the issue period, which is an either IPO or NFO, which we normally understand in that language, during the issue period, if you buy it, that is a primary market issues where the instrument will get allotted after the issuance. And if I buy it from the open market, then it is a secondary market transaction, which is being termed as.
Okay, 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 okay. Now, finally, one more question. Now, let's say when we say that, let's say bonds play an important role because they are less volatile and sort of predictable cash flows and all that sort of thing, right? Now, in which situation should I look at bonds and which situation should I look at debt mutual funds?
See, debt mutual funds will always have to. It's first, I would say that as an investor, you need to know that what is my goal of investment. Now, in case of the debt mutual fund, you can get a hybrid structure, you can get a liquid structure. Now, if I wanted to put my fund for say, for an example, for 1 month or 2 months, for that kind of a structure of an instrument, then I will be investing into a debt mutual fund or a liquid mutual fund, which is a genre of a debt mutual fund, for 1 month, 2 months, 6 months, for a shorter span of time. Secondly, in case of debt mutual fund, versus bonds, if I talk about bonds, is always been pretty much long term tenure. If I talk about, because bonds, you get a one benefit that whenever that corpus or the coupon, like say for an example, the coupon is 9%, and I have invested 1 lakh rupee. So 9% of the 1 lakh rupee, when I get it, there is no TDS which gets deducted, unlike in case of the FD where TDS get deducted, but it is always the income in the hand of the person, and it is taxable definitely. But if I talk about anything where I wanted to fixed my coupon for next 9 years, then bond is an instrument. But if I wanted to have a liquidity also to some extent, because maybe in a 1 year time or 2 year time, I can actually exiting from that particular instrument. Maybe then debt mutual fund would be a right instrument for you. But your the link of the debt mutual fund would be always with the money market, where the interest rate, what is the GSEC underlying, which is happening, that you need to understand, and that rate can also fluctuate in some point in time, and we have observed that also. So if there is any adverse situation into the GSEC, like say for an example, last couple of days or couple of weeks, if you see GSEC, which was also 10 years, which now got corrected at 7.27 types now from 7.38. Now, in this kind of a situation, like say, if you invest into a debt mutual fund like Bharat Bond, CPSC, then it is a separate type of a genre of ETF that you can invest with. But if I talk about a long-term orientation of an investment, then you should go for a bond. A medium-term orientation of a fixed asset class, then you should go for a debt mutual fund.
Okay, okay. Now, so actually, can you just explain when you said the 7.27, 7.3? So, could you explain the concept of the yield to our listeners in terms of, let's say, when I look at a bond,
Yes.
what is the thing called yield and coupon? What is the difference?
So say,
And actually, as a follow up question,
yes.
let's say, what is the difference between, let's say, a bond and a FD?
Okay. So I'll first answer this second one again. So if I talk about the bonds versus FD, so FDs are two types. One, it can be issued by any banks. It can be also issued by any one of the corporates. That's also a secured way of raising the money. But if I talk about bonds, so there are two type of bonds by nature of IM. Once you read the IM, you can get to know whether it's a secured bond or it's an unsecured bond. So in other parlance, I call it the secured debt, unsecured debt. Now, if it is a secured, then that means there has to be a pari passu, which gets created on the back end. Pari passu, the meaning of the pari passu means, say for an example, I am a company called ABC Limited, wants to get 100 crores from the market. If I am unsecured, that means I do not have any collateral, which you have given an example like a home loan. If I do not have a collateral to back for that particular loan, then it is unsecured. If I have a collateral, my future cash flow, my asset class, liquid, illiquid asset class, which gets attached as a pari passu structure, then it would be called as your secured instrument for the bond. In case of the FD, that's also a fixed commitment period for 3 to 5 years. You will get it because now the FD rate of interest are extremely good. Also, in few occasions you will find it is very very comparative with the bonds. In case of the bonds, it is listed into the exchange. FD cannot be listed into the exchange. So if you wanted to exit, early exit because of any exigencies of the liquidation of your instrument, that is possible in case of the bonds because you can still trade this into market. Now, if I talk about FD, then you have to forego, and there is a certain amount of a penalty clause which is there. Which would be paid, and you will not get that actual rate of interest on this. That is one. Now, say for an example, because as I said that it is listed into the market. So in case of listed into the market, so the TDS does not get applied in case of the NCD or the bonds. If in case of the FD, 10% TDS gets cut. If you do not give a 15H certificate, then otherwise it takes the 10% gets deducted. Now, say for an example, now coming to the subject of the yield versus what is a coupon. Now, coupon is a fixed, say for an example, 8% is a coupon that I wanted to give as an ABC Limited company. I want to offer a 10,000 face value of NCDs to my set of customer. Now, this bonds that bonds will have a three cash flow plan, which could be monthly, which could be biannually, which is half yearly, and third would be annually. Now, if I talk about what is an yield, that means what is an actual return of a particular customer when he's getting 8 or 9% monthly for an annualized calculation, then the yield is a instrument by which you determine that particular bond, what is an yield for that particular structure. Now, if I talk about any a rough estimation, like say, if I get some 8.5% and a monthly coupon, then my yield would be higher in compared to 8.5. So it would be my yield would be say 8.75 for that particular instrument. So now it is a ratio of the annual interest coupon payment for the particular bond market price. Now, if you are taking half yearly, then you have to factor in that half yearly you are getting 9%. How to factor that for an annual term? So your yield for that particular stuff would be little more higher. So yield is always is a ratio of annual interest or the coupon payment and the bond market price, which is the yield. And coupon is a fixed interest which needs to be paid out to the customers.
So how do I calculate this yield?
So yield calculation, say for an example, there are various way that you can calculate. Now, say any instrument when it get issued, there are issued in terms of the, at the time of issuance, you will find that the coupon and the yield for that particular structure is there. If I talk about the formula, I'll give you the formula. Just give me a sec. Uh, uh, it's not a hand. If I really talk about the formula, it is the coupon annual coupon divided by the bond price of that particular bond price during that time. Now, say instances if the corporate bond is say 1,000 rupees of a face value and 80 rupees is the coupon payment structure. So now it is trading at say 970 rupees in the market. Now, your implied yield would be the annual coupon divided by the bond price, which is the 970 rupees, and your implied yield would be 8.25%. Now, if I talk about the annual coupon divided by the bond price, so current bond price of that particular instrument, then the yield is coming. Is yield for that particular instrument will be coming.
Okay. Actually, so finally, so is it one last sort of
Yes,
question?
please.
Let's say that I'm interested in bonds, right? How do I go ahead and buy it?
See, I believe again for the retail investors perspective, I will answer this, and for the HNI perspective, I'll also answer this. For the retail investors, I would request to go for any mobile application like Paytm, like Zerodha, like IFL, like ICICI, any broking account that you should have. You should need to have a demat account because mandatorily the bonds has to be dematerialized, because unlike in case of FD, because in FD still the warrant, what we call the fixed the paper, that paper comes to your place in your residence, that's called the bond warrant. But in case of the bond, it has to be dematerialized. That's point number one. Point number two, you should first go through the primary market application rather than buying from the secondary market, because in the secondary market you have to always understand what was the issue price, whether the particular bond is being trading at a premium or at a discount. That's point number two. Point number three, whether it is a monthly or a bi-yearly or annual coupon. Now, what is the record date of that particular bond? In case of the record date, before record date you are buying, then accrued interest would be there with the seller which is there. Now, if you buy after the record date, then the pricing of the bonds would differ. So, what I would first suggest for any retail investors to invest with, go to a primary market, go to any mobile apps or any open any broking account that we have with any brokers. You get to see all the NFOs, like NFO, the issues are coming in NCDs. There are many applications or many brokers they have given, like Zerodha, IFL, Access Direct, where you can buy the secondary bonds, like say Uttar Pradesh, UPPCL Power, Andhra Pradesh, Beverages, any bank bonds that you can buy, 81 bonds that you can buy. That's for the HNI. And it is pretty much seamless. Seamless means you just go check, you understand what is the accrued interest, total accrued interest, what is the total price of the bond at this moment, what would be the cash flow, whether they have a call option in that particular bond. Understand that well first, and you transfer your prior amount from your bank, and immediately it comes to your demat. So it is as simple as that for any investment which is more than 10 lakh, even 1 lakh plus the bonds which are there into the market from the secondary market to buy in. But for the retail investor, I would always suggest go for an SGP and other NCD issuance which are there into the market. From the primary market, you can hold it.
Okay, cool. Thanks, Rohit. Actually, Janvi, if we could, I think we just have about 15-20 minutes left. Why don't we sort of open it up for questions from the audience, so that if they have any questions or doubts, we can sort of clarify it. Rohit. Janvi. Uh,
I
just a second, guys.
I believe anybody can just send a request for as a speaker.
Hey guys, Dilip, can you hear me?
Yeah.
Yeah, I can hear you.
Sorry,
Yeah.
I'm
So,
facing some technical difficulties. Okay, please carry on.
hey, Janvi, what I was wondering was, how do we let the audience ask questions? Should they raise a request? And
They can probably go to our page on our post for this event and probably post their questions over there. I can source them while you guys keep talking.
yeah. Okay.
Yeah,
Okay.
I'll.
So, is it any sort of concluding remarks in terms of what is the role of bonds in, let's say, an investor's portfolio?
See, that's what I was also trying to address upon, because whenever retail investors now, a unique example I'll give you during the COVID time, 1920, you will find that there has been a huge amount of inflows which has started coming in the demat. People started opening demat accounts, started investing into the equities. In ups and downs, they have earned good amount of profit. Now, if I talk about, is there any fixed logic of a percentage a person invests into the equity or the debt? My answer to this would be no. It's purely depends on the risk of that particular person they wanted to take. To what is my investment mission? Now, say for an example, if my daughter is 8 years and I wanted to place and I wanted to create a pool of money when she will be going for IIT or IIM. Now, for that, my investment should be a mixed blend of a mutual fund and a bonds. Now, if I'm a retired at the age of, say, I'm a little early, I'm planning for little early retirement, then my investment would be a little more higher in terms of allocation into the fixed asset class rather than an equity. So, thumb rule, what we have seen in the equity, people put actually a lot of money into uh, the directly into the market, but there has to be a blend of asset allocation, because we always see, and I always suggest that it should not be more than 30% of your total investable surplus or investable corpus that you will be investing into the equities. uh, Despite being, I'm representing one of the wealth management firm and a broking institution, despite that, I always say that your investment should be 30 to 35 or 40%, depending on the class of investors that you are in. You should invest into equity. Rest, there is a fixed income asset class or the debt asset class that you should look at. Because, see, the surprising fact that, Dilip, that there are a lot of data which gets captures about the DIIs, FIIs, inflows in the equities. There are very less amount of data which get published into the newspaper in terms of how many what is that FIIs and DIIs are invested into the date equity date markets. And if you see that kind of a number, that's a phenomenally high in compared to the equity. So if I really talk about for any first one is a retail investor, then you should have a proper blend of the market. Now, say if you are a very very aggressive investors and last over 3 days or the last over 6 trading days, there has been a capital erosion of at least 2 to 2.5% that we have observed. That is a good time to accumulate of various instrument, various equities also. But however, if you would have had a proper blend of a fixed income and at the same point in time equities, would be a right proposition. So in my sense, equities class should be 35 to 40%, and the debt asset class should be pretty much like say 60 65%. Now, another topic I just wanted to brought in, because this discussion has become very interesting. Like, You have seen that very recently, SEBI has come out with a new guidelines which call that in case of the unsecured debt, it has to be minimum 10 lakh rupee. Because if you recall that there are companies like Cholamandalam and others, they have raised unsecured debt, uh, unlisted unsecured debt in a form of little lesser of the face value, and they mopped up in the market in first 2 hours or 3 hours because the kind of rate of interest they assured. So I believe the SEBI is now playing a very, very critical functional role here because there are a lot of retail investors I could see has started coming in into the bonds because if you see the kind of money which is getting raised over this last 1 year, it is phenomenally large. Uh, and for the borrower, it is also an easier instrument rather than going to a bank and raising money, liquidating or giving a collaterals on that. Maybe based on your future cash flow, you can immediately come out with an NCD, and it's pretty much secured of a way of giving back to the people. And your cost of capital is also very, very less, like say 8.5, and then your distribution markup pulled together is 9.5, on which you can raise the capital from the market. It's a pretty decent way of raising money as well.
Okay. Actually, good. I think it was a really useful and an interesting discussion. So, thanks for coming. Guys, if you have any questions, you could sort of actually we have an interesting question from there. Do bond rates have impact due to international rate change like Fed/Japan monetary policy? Actually, it's an interesting question from a secondary market perspective. How do the sort of bond prices react to uh, rate changes either locally or globally?
See, I could see there would be an immediate impact onto the GSEC. What I said that I'll give you a small example. Now, you want to put money for the next 5 months and securely earn 7.35%. You please go and buy Edelweiss bond, which is a CPSC, or they have a structure of an FOF on which you can earn. Now, if I talk about, we also deal with a lot of institutional customer, the large ticket size volume. On those kind of a cases, what we have seen the customer or the or the forex customers who buys GSEC and they pledge that GSEC and they trade with us. On those kind of a scenario, what we have seen that if you see that last over couple of days only the GSEC rate got corrected. The GSEC yield curve, if I really talk about, I'll give you one perspective. I was going through a article, which is a very nice article. Like say, 10-year benchmark is GSEC is at 2032 as a 7.26. The yield open on the day now is a negative. Now, if I talk about just a 10 days back, the yield curve was completely positive on that point in time. So GSEC auction, if I really talk about that, that auction rate cutoff is at 7.23 versus 7.26 on the GSEC 10-year benchmark of 2032. Now, if I really talk about the impact of this bond for those retail investor, I don't think that there would be a large impact at this moment. But yes, once the FedEx rates, which is going up, I believe that in other way for the investor, it is a good time to invest into the bond and the fixed income asset plus like FDs, corporate FDs, because you'll be getting more and more return. Because cost of capital for the borrowing would be more expensive for the people, for the corporates. So they would be coming out with a higher coupon rate for the people. So say for an example, another 100 basis point if that rate hikes happens even over the next say 12 months, I believe that the bond coupon would also get appreciated. That is point number one. Now, if I talk about that, there has been yield curve into the GSEC, there would be a lot of impact and also stressed onto the side because that would be getting corrected. That's my view.
Okay. I hope well that sort of answered your question. The basic thing is that I think from a retail investor perspective, I don't think it has as significant impact. Right, this global monetary policy changes affect the government securities market. When you're looking at corporate bonds, and especially if you're sort of locked in your rate at the time of investments, you sort of, I think you can to a large extent ignore these macroeconomic moves, and in some ways that is the whole point of investing in bonds, that you don't have to look at SGX में क्या हुआ, S&P में क्या हुआ, right? That's the whole point of this whole exercise, right? That you don't have to worry about such things. Cool. So guys, if you, I think we would sort of like to close at this point in time. If you guys have any questions, please do sort of uh, reply to our post, so that we can answer your queries on the thread itself. But otherwise, I think we're done. Thanks a lot. So it's
Thank you so much, Dilip.
for taking your time, and
Thank you so much, Dilip,
yeah,
for having me here. Just wanted to say hi to Varun, who is also a listener. Thank you so much, Varun, for
hey, hi,
listening
Varun.
to be a part of this. Thank you, Dilip,
Cool,
for
cool.
inviting. I believe this is a very, very right subject at this moment. People should understand about the investing into the bonds, and very, very critical. And you will find that there will be a floods of NCDs and bonds which are coming in. I was surprised yesterday. I got a call from one of the issuer that Indore municipality, they are coming out with the bonds. You must be knowing that next week they are coming out.
Yeah,
So you can understand the kind of a floods which are there. Even Tata, they are coming out with that. The primary they have just closed. Uttar Pradesh second round is going to come up. Andhra Pradesh the second round is going to come up. So you can understand the kind of capital raising which is happening is crazily into the market now. Good. It's a nice discussion. Thanks, guys,
yeah,
for being here, and thanks for inviting me. Take care.
yeah. Thanks. So, Zanvi, I guess we could sort of leave now, right?
Thank you guys so much for taking time out on a holiday Saturday. I know it's almost Christmas Eve. So thanks everyone, and watch out for the next Bonds Pe Charcha as well.
Merry Christmas
Thank
to all.
you.
Thank you.
Bye.
Yeah, thanks, Merry Christmas.
Yes.